third Tutor Center for the course Finance 2. My name is Fredrika, and together with Lamin, we will hold this Tutor Center today, where we'll go through 3 questions and the following, which are the following. So we will start with the question A from the practice exam 4. And in this question, we have a company named Summertime operating in the tourism industry. The company is currently an all-equity financed company and expected to operate forever as a perpetuity. Their cash flows are expected to grow by a rate of 4% each year. The company's current market value is $200 million, and their corporate tax is 20%, and their market risk premium for the whole market is 5%. I will give you some time to write this down. Yes, so furthermore, we have received some information about other companies working in the same economy. So here we have information about 3 other companies, we have 2 tourism companies and 1 electronics company, which each equity beta, debt beta, and debt to equity ratio. We also have some information about a retail company in the same economy, and they have a 10-year bond with a yield to maturity of 7%, a default risk of 2.2%, and expected loss rate of 60% if it defaults. Furthermore, they have a debt beta of 0.736. So given this information, our task is to answer some questions following. And the first one is stated here. We should calculate the WACC, the weighted average cost of capital, and expected returns on asset, it should say, of the Summertime company. Yes, so as we did the last time we did a question like this, is that we will state the following equations needed to calculate the weighted average cost of capital and the equation for each variable needed. And as it was stated, Summertime is a company that is all equity financed, and we need to incorporate that when we are calculating and when we are looking for the weighted average cost of capital. So the normal equation for the WACC is stated here, which is the equity through the value of the company times the return on equity, the required rate of equity, and the debt through the value of the company times the debt rate and the cost of debt, and times the 1 minus tax. But since we know that this company doesn't have any debt, this variable becomes 0, and this whole term becomes 0. And this term over here becomes 1, since it is E divided by E, which means that we only have the RE left. And since we know that this is an unlevered firm, since we have no debt financing it, the RE will equal the RI and the RU. Any questions on that? Because that is one of the main assumptions or main insights we need to know before following through this question. Yes, so by that we know that the only variable we actually need to find in order to calculate the WACC is the RU, the unlevered rate. And the basic calculation for that is the risk-free rate added with the unlevered beta times the market risk premium. So what we need to know and what we need to calculate is the risk-free rate and the unlevered beta, since we already have the market risk premium stated at 5%. Yes. So how do we get the risk-free rate and the unlevered beta? As we received earlier, we have some information about the other companies in the economy that we can use to receive information about the company's summer times. Because even though the other company working in different industries in this economy, we can use the information about them and their rate of debt or debt beta in order to receive the risk-free rate, since the risk-free rate is the same for all of the companies in the same economy. So we will begin looking at the retail company, and the two first points state the information given about it. And furthermore, we know the equation, that debt rate or RD is equal to the yield to maturity minus the risk for default and times the expected loss rate. Plugging in the numbers we have received, we receive an RD of 5.68%. So the only thing I've done here is to state the equation and plug in the numbers. And then when we have received the RD and we know the market risk premium and the debt beta, since it's given for us for this company, we can easily solve for the risk-free rate for this economy. Important to know is that we are still using yes, so important to know is that we are using the specific numbers given for the food or the retail company working with foods. But since we are looking for the risk-free rate that applies to the whole market, we can use this risk-free rate when we are calculating for the WACC for the company's summer times. Okay, so the only thing we need to know now is the unlevered beta in order to proceed with our WACC calculation. And most often it is received by numbers given for firms working in the same sector as the companies we are studying. So as you might remember, except the food retailer, we received information about 3 other companies. And when we are looking for the unlevered beta, we know that the unlevered beta for our company's summer times is equal to the unlevered beta of the companies in the same sector of the economy. And that would be the tourism sector, since that is what summer times works within. So this is an assumption that the unlevered beta of your company is equal to the unlevered beta of the other companies in the same economy is an assumption that you most often make when receiving these questions. And furthermore, we know these following equation could help us receive the unlevered beta. So we know that the unlevered rate of return is the equity through the value of the company times the RE, added with the debt through the value of the company times RD. And then we have the CAPM formulas for both the RE and the RD, which are quite similar. And we have the unlevered beta, unlevered rate of return, as well through the CAPM formula. And again, important to know, we are using the risk-free rate as we calculated before. So that step is needed done before this. And we have the market risk premium from the information received in the question. And we have the equity beta and debt beta for all of the companies working in the tourism sector as we receive them. Any questions on that? Super. So since we have two companies working within the same industry as Summertime, Turisco and Thomas Crook, we will now calculate their individual unlevered betas and then take the average of them in order to receive an unlevered beta that we can apply for the company Summertime. And for the company Turisco, as we received some information about and was working in the tourist industry, we just plug in the numbers previously received about this company in order to receive the different variables. And again, the thing we want to solve for is the unlevered beta, which is the last equation here, where we use the CAPM formula for the unlevered rate of return, and then solve for the unlevered beta in the equation. I will give you some time to write this off as well. Yes, so this was the unlevered beta for the first company working in the tourism sector. And now we're going to do the exact same thing with the exact same equations for the second company as well. So there we have Thomas Crook. And again, we use the first three equations in order to receive the the first two equations in order to receive the rate of unlevered return and use that in the CAPM in order to solve for the unlevered beta. Again, I want to point out, even though you don't see it, all these numbers stated as the equity beta or debt beta or the equity true value of the company is received above in the main question. And then when we have calculated Thomas Crook's unlevered beta as well, we will just take the average of the unlevered betas for the two firms in order to receive the unlevered beta that we will use as Summertime's. So this is a simple equation. Important is that we received three companies. I don't know if I mentioned this before. We received three companies, but we only took the average unlevered beta for the firms that worked in the same sector or industry as the company that we are looking for. Yeah, as Summertime did. Yes, so now we only have one simple step left, and that is to calculate the WACC, which we previously stated was the equal of the RE and equal to the return on assets and the unlevered return, since it was an equity financed company, and that is really important to understand. And therefore, since we have the unlevered beta, thanks to this other firms working in the same sector, we can just use the CAPM formula to receive the WACC, or the unlevered rate of return, which is equal to the WACC for this company. Any questions on that? Super. Then we will move on to the second question, which is calculate Summertime's current EBIT at t equaling 0 And to this end, we assume no depreciations, amortizations, no working capital adjustments, or capital expenditures. Okay, so then we need to ask ourselves again, so what do we know about the company that we can use in order to receive what is asked from us? So from the question or the information stated, we know that the market value today at T0 is $200 million. We know that this valuation is based on the future cash flows of the company that is discounted to today. We don't need to adjust for any depreciations, amortizations, change in the working capital or capital expenditures, which means that the free cash flow is equal to the EBIT adjusted for the tax. And that, yes, and that is due to the assumptions that the depreciations, amortizations, change in the working capital and capital expenditures is equal to zero. And then we don't need to do the adjustments to receive the free cash flows from the EBIT adjusted for the tax. Furthermore, we know that the formula for the valuation of the company to receive the market value is to discount or to take the free cash flows occurring at year 0 and discounting them. And since we know that, as stated above, that that this company will operate forever, it becomes a perpetuity. Yeah, I think that's what it's called. So you don't discount each free cash flow each year separately, but you can use the free cash flow at year 1 and through this formula receive the market value of the company. However, as the question states, we are not interested in the free cash flow or EBIT at year 1, as this formula states, but we are interested in the EBIT or free cash flow at year 0. So we have to adjust for that in our formula. And since we know the growth rate of the free cash flow is equal to 4, we can state free cash flow year 1 equaling the free cash flow year 0 times 1 added with the growth rate. Since we know that this is what the free cash flow, this is the rate that the free cash flow flows will grow with. And then again, we divide it with the WACC minus the growth rate. Okay, so now we plug in the numbers that we know from the question. And that is that we know that the market value is 200. We are looking for the free cash flows or the EBIT at year 0. We know that the growth rate is 4%. We know that from the last questions that the WACC is 7.5%. And again, the growth rate is 4%. And solving for this, we'll receive a free cash flows at year 0 to be equal to 6.731. However, in the question stated, they are not looking for the free cash flow, but they are looking for the EBIT. And as we stated before, the free cash flow is equal to the EBIT adjusted for the tax. So that is the last step that we need to do. So we know that when we don't have any, and that's important to know or to take with you in this question, that this equation the first one stated, only holds when the amortization, depreciations, working capital adjustments, and change in working capital is equal to 0. And that is actually what's assumed here in the question. So that's why we can state this first equation. And then we just plug in the numbers we have from both the question and the calculations above in order to solve for the EBIT. And we receive that the EBIT is $8.41 million at year 0, which is important to know. Any questions so far? Super. Then we will move on to the third question, sub-question. So the government has decided to increase corporate taxes to 40%. All other things equal, what is the impact on the firm value of summertime? So again, they are, what is concerned is the market value of the company, all other things equal. And by that, they mean that still the assumption holds about depreciation, amortization, change in working capital, and capital expenditures being 0. So again, since they are looking for the market value of the firm, we are stating the equation for the market value. And here, instead of the free cash flow year 0, as was stated here in the last equations, I have just changed it to the EBIT times 1 minus the tax rate, as we did before in 2 steps. And then we take that times the 1 added with the growth rate divided with the WACC minus the growth rate. And plugging in the numbers that we know with the new tax rate, important, we receive a market value of $150 million. So just by increasing the corporate tax, the market value of the firm is $50 million less than it was before. Okay, but the fourth sub-question is that after the increase in tax rate, the company decides to issue fixed perpetual debt in order to buy back existing equity. The cost expected return of the debt is 6%. How much money should Summertime raise through the debt issue to bring the firm value back to $200? Okay. As we discussed, the Tutor Center, the only thing separating separating the value impact of the firm, the value of the firm when issuing debt versus when issuing equity, is that the value of the firm actually increases when issuing debt, since a tax shield is created. So by simply stating this equation, that the leverage value, the value of the company when it's using debt in order to finance through financing, the levered value of the firm is equal to the unlevered value of the firm and the present value of the tax shield. That is what that's the basic way to state this. And as we know, with the tax rate of 40% in the economy, we calculated before that the unlevered value of the firm would be $150 million. And we know that they want to reach the levered value of the firm being 200, since they are issuing debt only to increase the value actually of the company. So by plugging in 200 and 150 in this simple equation, we can see or solve for that the present value of the tax shield actually has to equal $50 million in order to reach the desired firm value. And furthermore, since this is a perpetual debt in the eternity, we know that the equation for the present value of the tax shield is equal to the tax rate for the firm times the debt that they will issue. And we know that the present value of the tax shield has to be $50 million in order to receive the firm value of 200. We know that the tax rate is 40% after the increase. And then we are looking for the debt. And by solving this pretty simple equation, we receive that the issued debt needs to be out of the size of $125 million in order to receive the desired firm value of $200 million. Any questions on that? Yes. So the question is if we could repeat the answer to the first question on expected return on sales. And again, I want to state that it should state, I can change that immediately, I think. It should state that we are looking for the expected return on assets. Let's see if I can change this. Okay, I can't change in the PowerPoint now, but I want to state that they are looking for the weighted average cost of capital and expected return on assets. And again, when we looked and analyzed the WACC equation and realized that this company doesn't have any debt, so that this term becomes zero, this will come zero when we multiply with zero, and the equity through the equity is 1, the WACC will be the same as the return on asset, unlevered return, and return on equity. So what we have actually done when calculating the WACC or the unlevered rate return, we receive the returns on assets immediately since it's the same. Does that answer your question? Yeah, super. So I will change this in the PowerPoint before I post it in the Facebook group afterwards. Any other questions on anything in this particular question? Super. Then I will hand it over to Lamin, who will go through the second question on the third question.
Thank you. I'll start sharing my screen. Hi, everyone. Welcome back to today's session. We would be looking at 2 questions from the June 2018 exam. The first one is regarding the implications of information asymmetry on markets. The information that we have from the question is as follows. But before we go further, if you have any questions, feel free to either unmute and raise your hand and ask, or I will let you in, or you can just write and I will read it out. So the information that we've got on this first question is as follows. There is a firm that is called ABC. We also know that the investors in this market are risk neutral, which means that the riskiness of the cash flows do not affect the price of those cash flows, the present value of those cash flows, in essence. We also know that there is no discounting, which means that the value of the cash flow 1 year from now is the same as the value today. Again, we also know that there are two types of farms in this economy. There are the type 1 farms that have an asset of 120 million, and there are type 2 farms that have an asset of 50 million. And then we are given the frequency for each type of farm. Here we can interpret the frequency as the proportion of the overall farms in the economy that belongs to each of the categories, right? So that in essence, what this means is that 30% of the farms or companies in the economy belongs to type 1, and 70% of the companies in the economy belongs to type 2. And obviously, this information would become useful when we start calculating the expected value in the subsequent correction. Then we also have an important assumption here that information asymmetry is the only imperfection in this market. What this means is that the managers of the company knows more about the company than the investors. And this would become important as we will see in the subsequent sections. Then the final true information we have is that farm ABC is all equity finance and it has 80 million shares. Another point is that the manager of the company is also the owner, right? With this information, we can move on to solve the questions that are asked in this part. So the first question was to find the market value and price per share of farm ABC, right? And if you remember from the previous slide, we know that the investors do not know which companies belong to which category, right? So for an average investor, the best guess at the value of a company is the expected value of the two types of farms. So in this way, to find the market value, we just take the weighted average of the two types, the asset value of the two types of companies, to arrive at the market value of an individual company, which is basically an estimation or our best guess for a value, since we don't know which company belongs to which category. So in this case, we know if we use this method, we arrive at 71 million as the market value of farm ABC. Then the second part is the price per share. Once we find the market value, it's basically dividing the market value with the number of shares to arrive at the price per share, right? And then below, I just made a quick explanation about the fact that because we don't know which farms belong to which category, we can only make an estimated guess, which is the expected value, right, using the frequency. The second sub-question in this question is that there is a new project that has an initial investment of 70 million. And then the interesting part is that the NPV of this project depends on which type of farm does the project, right? So if it's a type 1 farm, we know that the NPV of the project would be 20 million. And if the project is done by a type 2 company, the expected the NPV of the project would be 10, right? And in order to find the expected value of expected NPV of this project, we have to do the same like we did previously. We have to take an expectation of the NPV, which would be 13 million. So if farm ABC would do this project, the new market value of farm ABC would be the old market value, which is 71 million, plus the 13 million, which is the expected NPV of the project. And this would give us 84 million in total value, right? And now we need to find the new price per share, which should be the new market value divided by the number of outstanding shares, right? And now we see that the price per share of the company will be 1.05 euros, which is slightly higher than before. And this is because the company is going to do a positive NPV project. Then the next part of this section is to understand how many shares that the company Farm ABC will have to issue in order to finance the investment, right? We know that this investment is going to cost 70 million, and we know the price per share, right? So to find how many shares that the company needs to issue, we just need to divide the investment cost with the price per share. And this would give us 66.67 million new shares, which is the amount of shares now that Farm ABC would have to issue in order to raise 70 million to invest in this project. I will pause briefly so that you can take notes before we move to the next sub-question. And if you have any questions, you can feel free to ask in the meantime. Cool. So in the third sub-question, we need to analyze equity financing and adverse selection. I guess you guys have discussed about, with the professor have discussed about adverse selection in financial markets. But in essence, what this concept means is that when the seller of a product knows more information about the buyer. Okay, there is a question, so I'll pause for a moment. And the question is, why do we divide by the new price per share? So I'll go back there. We divide the new price per share because the price of a company is based on the expected value of the company or the expected cash flows, in other words, right? So in the question, it's mentioned that the market is sure that the Farm ABCD would do this project, right? So if the market knows that for sure Farm ABC would do this project, and they know the expected value of the project, this information would reflect in the market price per share of the company in terms of the new NPV. And this is why immediately the announcement is made, the company's share price would go up, because this new information is now incorporated in the share price of the company. And this is why we need to divide with the new share price. Does that answer the question? Okay, good. So we were talking about the third question. So with regards to adverse selection, what this means is basically that when sellers have more information about the product that they are selling than the buyer, it's very likely that the buyer would underprice this product because they have less information about the product than the seller. And because of this underpricing, eventually all the good sellers in the market would walk away because the price would be very bad to sell good products, and only the bad products would remain in the market. And basically that's the concept of adverse selection, and we would see how that works with this specific question. So what we are asked in the question is, which of the two types of companies would do this project based on the initial investment amount? And to know this, to decide on which companies would do the project, we have to understand what is the change in the share price, in the equity values of the old shareholder, right? Because in essence, the old shareholder would be only willing to do the project if it increases their equity value, and they will not do the project if it would decrease their equity value. Yes. So we will start with the type 1 companies. Here we know that the equity value before the project would be 120 million. And here you will notice that now we, instead of taking expected value, we take the true value, because we know that the owner of the company is the manager, and then they know which type of category the company is, right? So for them, they know the true value, and if it is a type 1 company, it means that the true value would be 120, right? We know that with the issuance, with the new investment, they would raise 70 million, and then this would increase the asset value to 210, which is basically the old equity value. plus the NPV of the investment, which is 20 again, because we know that this company belongs to a type 1 category. And then the 70 million that they would raise, and total asset value would be 210. Then we need to understand what proportion of the company would be held by the old shareholder once they issue a new equity, right? And we know that this would be 80, which is the new equity that would be issued that we found in the previous, sorry, the 80 is the old shares that are held by the number of shares that are held by the old shareholder. And we know that they would issue 66.67 new shares. So the proportion of the company that would now belong to the old shareholder will be 54%. And once we have all this information, now we can move ahead to calculate the change in equity value, right? Which is basically defined by this formula, the new asset value times the percentage held by the old shareholder. And now we see that the equity value of the old shareholder would be 114 million, right? Then we know from beginning that it was 120, and with the project it would be 114. Then it means that the equity value of the old shareholder is going to decrease by 5 million. And based on this, we know that the old shareholder would not take the decision to do this project, because in other words, it's a negative NPV. It's going to decrease their equity value. So for a type 1 company, we know that they will definitely not do this project, even if the project is a positive NPV, as we have already seen. I'll pause for a moment so that you can take notes of the solutions for this part. Great. So now we can do the same process for a type 2 company to understand if this type of company will do this project or not. We know that the equity value before the project for the old shareholder for a type 2 company is 50. And this is the true value. We use 50 because we already know that the manager is also the owner of the company, and they know which category the company belongs to, right? So if the company is type 2, we know for sure that the equity value is 50, right? And then with the new project, the new equity value, the new asset value would be 130, right? Which is the old equity value plus the NPV of the project plus the investment cost of the project. Then equity value of the old shareholder after the project would therefore be 130, which is the total asset value, times the percentage held by the old shareholder. And this would give us a new equity value of 70.9 million. And now to understand what the decision would be, whether the company would do the project or not, we need to calculate the change in equity value for the old shareholder. So we know that the new value is 70 million and the old value is 50 million. So it means for the old shareholder, the equity value is going to increase by almost 21 million, right? And based on this, it's definitely clear that the company will do the project. In this case, because at the end, the equity value is increasing. So this is a positive NPV project for the old shareholder, right? And I think the conclusion that we can draw from this subsection is what I've explained before. When there is adverse selection in the market, which means if the managers of the company have private information about the company that investors do not know, it is very likely that the sellers in the market, so companies that are issuing equity will only be companies that are not good, because the price level in the market would be such that good companies would be underpriced and they will move out from the market. And in a sense, from a theoretical point of view, that's the impact of advanced selection in a financial market. Yes. So the fourth question, it's basically the opposite of the previous one. Before it was equity, and now it's debt. So what we are told is that it's the same project, the same investment cost, the same expected NPV, and the difference now is that the project would be financed with debt instead of equity, right? And now we need to do the same process as before. We need to understand the change in equity value to understand which of the companies would do this, would eventually decide to do this project. Here, so we start with a type 1 company, and we calculate the new asset value after the project, which would, as before, would be the old value of the company, plus the NPV of the project, plus the investment cost, and then this would give us 210 million. We know that to finance the new project, the company needs to issue a debt of 70 million. And then from these two information, we can easily calculate what is the equity value, because we know that always the value of assets is always equal to the value of equity plus the value of debt. So since we know the value of asset is 210 and we know the value of debt is 70, we can drive the conclusion that the value of equity is 140 million. And obviously it's clear that this is higher than the whole equity value. And based on this, we can definitely conclude that type 1 firms or type 1 companies would definitely do this project, because this project is NPV and the equity value for the old shareholder would be increasing. Now we can do the same process for type 2 companies. And again, we know that the new asset value would be the old asset value plus the NPV plus the investment cost of the project, which would be 130 million in terms of the new asset value. Then we know that they need to issue debt of 70 million in order to finance this new project. And therefore, we can calculate the equity value as to the total asset value minus the value of debt, which in this case would be 60 million. And again, this 60 million is greater than the old value of equity, which was 50, right? And now we can conclude that also type 2 companies would also do this project in case of debt financing, right? And here we can see a very significant difference. We know that if this project was going to be financed using equity, only type 2 companies which are in essence the not so good companies would decide to do the project. But we see that when there is debt, both type of companies would do this project, because both types of companies would benefit from an increase in the equity value of the old shareholder, right? And this is because the price of debt is less sensitive to information than the price of equity. And the reason for this in general is because debt holders have a contractual claim. So debt cash flow is a promised cash flow to the debt holders based on a contract that a company has with the debt holder. So whatever happens, as long as the company is not bankrupt, they would make these payments. And obviously, sometimes it happens that companies do not end up making the debt payment, but there are consequences when this happens. And because of this, companies try to avoid that as much as possible. But for equity, on the other hand, there is no promise that you are going to pay dividends to equity holders, right? So that entirely depends on the company's management. And because of this, the value of equity is very, very dependent on the information about how the company is going to perform. And whenever there is lack of clear information on the company's performance, it has a negative impact on the share price, because basically investors do not have enough information to price the company's shares in the best possible form, sort of to reflect the value of the company, right? And that's an important difference between debt and equity financing, apart from the interest tax seal and all other concepts that we have already seen before. So the fifth part, I'll just pause a bit so that you could take note of the solution studies. And also feel free to ask any questions in the meantime that you may have. Cool. So we can now proceed to the final part of this question, which is more of theoretical than the previous ones, right? So what the professor was asking in this exam was, what theory have you seen from the solutions in the previous sub question? And obviously that's clear. It's clear that companies between debt and equity, companies would generally prefer to use debt to finance projects than equity, right? So this is a very well studied theory in finance, and it's called the pecking order theory, right? So when companies have an option to finance a project between debt and equity, in most cases, companies would prefer to issue debt to finance the project, right? And obviously, there is one extra element to this theory, which is the internal cash flows, right? So if companies have enough cash, internal cash flows are the same as retained earnings, and this is basically the amount of profit the company makes that is not distributed as dividends to the shareholders, right? So whenever this amount of this money, this kind of earnings, retained earnings is available to companies, they usually prefer to use the retained earnings to finance projects as opposed to either debt financing or equity financing, right? So in terms of the order of priority, it's internal cash flow first to finance projects. If this is not available, companies would use debt. And if that's not available, then they would use equity, right? And then then eventually you have the signaling theory of equity. And this is why in most cases, when companies issue equity or announce that they are going to issue equity, their share price usually fall down because investors immediately sense that the two other options are already not available. And that's not a good thing for a company, for the future of a company, sort of. And that's all from this question. If you have any questions that you want to ask or clarifications, feel free to ask before we move on to the next one. Okay, good. It appears that's clear so far. So we move to the second question. Again, this question is also from the June 2018 exams. And if I remember right, I think it was a 25-point question. This question is about mergers and acquisitions. And generally in mergers and acquisitions, we have two parties. We have the acquirer, which is the company that wants to buy another company. And we have the target, which is the company that is to be bought, or the company that the acquirer wants to buy. So here in this question, we are given some information about the acquiring company, which is called Acquaro Metal, and the target company, which is called Darboe Steel. If we start with the Acquaro Metal, we know that the earnings per share is 2 for the company. We know the shares outstanding is 10 million. We also know that the price per share is $20 per share, not 20 million, $20 per share. Obviously, this information would become very useful in the subsequent questions. So in exams, it's always helpful to kind of sort of write these key points so that it's always available whenever you need them and you can fall back on them easily without having to read the correction all over again. With regards to Darboe, we know that the earnings per share is $1.25 per share. We also know that the shares outstanding is 4 million, and we know that the price per share is $15 per share. Another important, we know that another two important parts of an M&A is the synergies, which is basically what extra benefits are the two companies going to get from doing the merger. And the other important component would be the premium, which is what is the extra amount that is going to be paid on top of the standalone value of the target company. Because usually when companies do M&A transactions, when you bought another company, you end up paying much higher than, or at least quite higher than the standalone value of that company. Right. So the first question here is for us to find the price per share of the combined companies, right? Once the announcement for the merger has been made. Here it appears to be like a simple question, but we would have to do quite a number of steps in order to arrive at the final solution. And as always, it's really helpful that you do the steps in a sequence so that it's less likely that there would be mistakes. But also part of the information that you do on some of the steps you would need later, then it's very, very easy to just pick the information that you need. So here first we would have to understand what is this value of the acquiring company, and usually in M&A this would be called standalone value. Standalone is used just to emphasize that this is the value of the company if there is no M&A transaction, right? And here we already know the share price of the acquiring company, which is 20 from the previous slide. We also know that they have 10 million shares outstanding. And then based on this information, we can definitely easily calculate the value of the company, which is in this case 200 million. Then we also need to find the standalone value of Darboe, which is the target company to be bought. And also from the previous slide, we know that the price per share of this company is $15. We know that they have 4 million shares outstanding. And with this information, we can calculate the standalone value, which is 60 million. Then once we know the standalone value of the acquiring company, in this case, acquirer, and we know the standalone value of Darboe, we can calculate the merger consideration, which is the price that is going to be paid for this acquisition, right? The price that is going to be paid for Darboe. Here in the question, we are not given the price, but we are given the information that the premium, which is the additional amount to be paid on the price, is 20%, right? So based on that information, we know the standalone value, which is 60. So we know this is the value of Darboe, and we know that 20% extra will be paid on this value. Based on this information, we can calculate the consideration, which is the offer for Darboe. And in this case, this is 72 million, which is basically 60 times 1.2. The 2.2 is the share premium, and then we have the formula here. Then now we know that the company is paying 72 million for Darboe. At the same time, we know that Darboe is worth 60 million. And this would definitely give us a premium of 20%, as said in the exercise. Then the key part, usually in M&A questions, is the exchange ratio, which is basically in terms of stock transactions. So what is happening here is that this consideration of 72 million would be paid with the stocks, with the shares of acquirer instead of cash, right? And whenever there is a stock transaction in an M&A, it's very important to determine the exchange ratio, because that would determine how many shares are going to, new shares are going to be given to the target company shareholders. So we can define this ratio as capital R or small r. There are two processes that we get, two ways that we can solve this, and we would see both. In an exam, you can decide which one is more easier to do within the context of the exam, and go with that. But I think it's useful to know both processes, right? So we would start with the capital R, which is the proportion of the number of shares, the total number of shares of the acquiring company that should be given to the target company shareholders. We don't know R, but we know that R times the value of the acquiring company should be equal to the value of Darboe times 1 plus the premium, right? And now I'll try to explain this formula. So we already discussed what R is. We know here we have the value of the acquiring company. And based on that, we know that R times the value of the acquiring company is basically the value of the acquiring company that would be given to Darboe shareholders, right? So at the end of the transaction, they would transfer R number of shares, and this is the R percentage of shares, let's say, and this is of acquirer, and this is the value of acquirer. So if you multiply these two, you would have the value that is going to be transferred to the target shareholders, right? To the Darboe shareholders. At the same time, we have another equation. We have another value here, which we know that should be equal to this, the left-hand side of this equation, right? And this is the consideration, which is the amount that we know they are going to pay for Darboe, right? And this calculation we've already done in point C, and we know that this is 72 million, right? Now with this information, we know the value of acquirer, we know the consideration amount. R is the only information that we don't know. We can just plug in the numbers that we know and solve for R. And in this case, we find that R is 3.6 million shares. So this is the total number of new shares of acquirer that should be given to target shareholder, to Darboe shareholders, right? So at the end of the transaction, the shareholders of Darboe would hold 3.6 million shares of the acquiring company. Yes. If there is any questions here, feel free to ask. You can write, and then I will respond. Then the other approach here is that we can find R, the small r, and in this case, the small r would be on the per share basis, right? Generally, from my experience, this is easier. Okay, we have a question. Should it be 200 instead of 20 in D? Yes, it should be 20. There is D. Yes, it should be 20. Initially, there was a typo in the initial slide. I just realized a couple of minutes before the session, but it should be 20, which is the share price. Right, I think initially when I wrote, I mistakenly add an extra 0, and it was 200. But this is corrected, and I think we would Fredrika will help me to upload the corrected version later. But it should be 20, and now I'll explain why it should be 20. So we know that the value that they are paying is 60 times 1.2, 72 million, right? Now we want to understand how many shares that we need to give to them so that they obtain this value. And to get this, we just divide this by the number of the price per share of our company at this current moment, which is 20, right? And it's this is also literally the same process that you do if you want to understand how many new shares you need to raise in order to finance a project, like we see in the previous point, right? Does that answer your question? Right, exactly. Yes, that's for the small r, and we would see that. Yes. So her point is it shouldn't it be? Let me read it. It said it should indeed it is r times the price per aquaro equals to the value of Darboe. Yes. So this is, you could do that as well, but you can do that only with the small r, and that's the part E, right? So the small r, the big R is based on the total value, right? So here you see we are taking the total value that's going to be paid instead of the value per price that's going to be paid. And there is a significant difference here, obviously, right? With small r, we can find the value that is going to be paid for each shareholder, right? For each shares of Darboe, how much is going to be paid. And here, to get that, we just simply divide this value again, the 60 times 1.2, which is 72. We can divide it by 4, and we would have 18, right? So we know that 18 is the value that is going to be paid to each shareholder of Darboe, right? And now to know the small r, we just divide this 18 by 20 and get 0.9, right? So for example, in, let me see who asked the question. In Marlin's question, Marlin, in your question, in that formula, you could use this 0.9, and it will give you exactly the same amount of information, the same amount of the same results, basically, right? So depending on the context of the question, it's you can definitely decide which of these two to use. Usually, it's easy with the small r, because if with the small r, you can avoid a couple of other steps like we did here already, right? But then these are the two ways that you can compute this. Does that answer your question?
I'm not sure what you said, that you can use the small r or the capital R.
Okay. Sorry, can you repeat what your question?
So you said that you could use the small r in some case, and I didn't understand like when you choose which one to
Okay. Do. Right. Okay. I'll try to explain one more time. Thank you for bringing it up. If there's anything that's not clear, feel free to stop and definitely ask. I'm happy to. So the difference between, it's unfortunate that I don't have a writing, but it would have been easy. But let's see. So the big R, we use the overall value, right, Marlin? So with the overall value, what you are doing here, to convert this to a per share value, you are basically dividing with 4, right? And the denominator, which is 20, remains the same as we see here, right? So what you do with this, with the big R, to get to the small r, is just adding one more step into this process here. So you divide this value with 4, and then in this case you get the small r. But the small r is the value. It's the value of the new shares that is going to be given, the proportion of new share that is going to be given for each old share of Darboe, right? So what this small r is telling you is that for every single share of Darboe, the person is going to get 0.9 share of the acquirer, right? And now you can move from here to the 3.6 million by simply multiplying this amount, 0.9, with the amount of shares of Darboe, which is, if I remember right, which is 4 million, right? So 4 times 0.9 would still give you 3.6 million shares, just like you have with the big R here. Is it a little bit clear now? Okay, cool. That's good. At least today we are having an interactive session. So if there is anything that you want clarification on, or either to add some extra points, extra comments, feel free to do so. I mean, we are also not professors, we are students, so we are all here to learn something, right? Yes. But in this case, so you have these two processes to do. If it's still not clear for anyone, I could stay a bit after this session and we can go through it on a one-to-one basis. I'm happy to do that. Yes. So now we can move on. Now we know that they need to issue 3.6 million shares to the shareholders of Darboe. Now we need to calculate the total number of shares, right? Which will obviously change due to the new share issuance. So to have this, we know that before they had 10 million shares, they are going to issue 3.6. The new total number of shares is going to be 13.6 million. And this is one of the information that we need to actually answer what exactly the question is asking, which is the price per share of the combined entity. So now we have to find, we know the total number of shares, we have to find the value of the combined companies. How much would the companies be worth once they conduct the merger transaction? And here, this is almost always the case. The value of the combined companies is the value of standalone value of the acquiring company plus the standalone value of the target company plus the NPV of the synergies, right? So we already know these information. We know the value of the acquirer, standalone value of acquirer. We know the standalone value of Darboe because we've already computed above. Also, we are told in the question that the NPV of synergies is equals to 0, right? So this how you could interpret this information is that this particular transaction do not add any value to the two companies, right? It would continue, their operations would continue as it was when they were both separate companies. And then just for the sake of a general comment, usually this is not the goal of a merger transaction. Companies do M&A because they think by combining the two businesses, they can have added advantages. And these added advantages are what is referred to as synergy. But back to the question, we know that the standalone value of acquirer is 200. We know that the standalone value of Darboe is 60. And we know that the NPV is 0. So the combined value of the company is 260 million, right? Which is the sum of the standalone values in any case, because the NPV of synergies is 0. And now we can finally get to the question that is the actual question, which is the new price per share, right? And as always, that's always the value of the combined companies or the company, whichever it is, and we divide this by the number of shares that are outstanding, which is the new number of shares, which is 10 million plus 3.6 million new shares. With this, we see the price is for the combined company is 19.12, right? And here, one way you can think about this price, it's sort of the value of it should reflect the price of the acquiring company, right? Because once these two companies are combined, they become one, and it becomes the acquiring company. And one important observation to make here is the fact that now we see that the share price has decreased, right? Before it was 20, and now we see it's 19.12. Does anyone have a guess on why this is the case? I'll give just that 1 minute and see if someone would come up with a suggestion why the share price went down. Okay, let's proceed. Too bad, everyone. Okay, let's see. Okay, yes, that's true. Can you explain that? someone has just answered the question. Let's see if the person could explain that to all of us. That's absolutely true. That's the case.
So the reason why I said no synergies was because they don't get any extra value for the premium they pay for the company.
Yes. Exactly. So this is the point.
I don't know.
Yeah, that's the point. You absolutely answered the question. So that's the point. They paid a synergy, they paid a premium, so they paid more than the company is worth. But at the same time, they don't get any extra value for buying the company, which are the synergies, right? So it's basically buying something that is less than the value that you are paying for, and this is why the share price decreased, right? And then, as we will see in the subsequent section, this would have an impact on how much value that the Darboe shareholders would eventually get from this deal. For now, I'll just pause because these steps are long here, so that everyone could take note of the steps. If anyone wants to, just for a minute, I'll pause for just for a minute or two. Cool, we can proceed now. So the next question is the post-announcement share price of the acquiring company, right? And this is quite repetitive because it's basically what we've done already. Maybe because I anticipated it ahead, but that's basically what we did in the previous step. But there is another way of doing it, so that's what we would see in this case. And again, it would be just depend on you in an exam or in any other setting to decide the approach that you think is quicker for the given the context. So we need to find the post-announcement share price of Acquiro, which is the acquiring company. We know that the value of the combined company is 260 million. This we know because we did the calculation in the previous section. We know that 3.6 million shares would be given out to Darboe, and based on this, we can calculate the percentage that Darboe would hold of the combined company, right? And this is simply 3.6 million shares divided by 13.6, which is the total number of shares, right? So if we multiply this by the total value of the combined businesses, we arrive at the value of Darboe, so which is $68.82 million. Now with this information, we can fairly easily calculate the value that belongs to the acquirer shareholder post-announcement, which is 260, the total value, minus the value that belongs to Darboe. And this will give us a value of 191 million, right? And again, here on a total basis, you can see the decrease in the value for the acquirer shareholders. Before it was 200 million, now it's 191 million. So it dropped by about $9 million. So with this information, we can now calculate the price per share of acquirer once the announcement is made, which is the new value, 191 divided by 10, which is the total shares that belongs to the acquirer shareholders, right? So out of the 13.6, 10 belongs to acquirer shareholders and 3.6 belongs to Darboe shareholders. So if we divide the value with 10, we have a price per share of 19.12, which is literally the same value that we have in the previous section, but we use different approach, different processes sort of, right? So here you will always have this option to work around these corrections especially with M&A, there are usually a multiple ways to work around the correction, right? So it's helpful to understand this because in the exam, you could always decide which one would be the fastest or the most efficient way of solving the correction. So now this is just a small comment that we see that the price of acquirer drops due to the overpayment, like already explained to us by your colleague. I'll pause a bit so that you can take notes on this part of the correction. Okay, moving on to the third point of this correction, which is the post-announcement share price of Darboe. So again, it's as in the previous section, we need to know the value of the combined companies. That's always something that we would need, and that's why it's helpful that you always write that somewhere, that you can always look to and find and take the number. We also need to find the proportion that belongs to Darboe, which is the 3.6 divided by the total number of shares, and that's 26% of the company. And based on this information, we can calculate the value of Darboe shareholders, right, which is 68.82, exactly the same that we have in the previous subtraction. And now from here, we know that the current number of shares outstanding for Darboe is 4 million shares. And we know that the value that's belonging to them is $68.82 million. To find the price after the announcement of the merger, we just divide this value by the number of shares that are outstanding. And then we will have $17.2 per share, right? And just a quick reflection here, this is obviously higher than the amount that the price per share that the company had before the announcement, which was 15. So obviously this is a very, very good moment for the shareholders of Darboe, right? And usually this is the case when there is a merger and the acquiring company overpays for the target company. Because if you overpay, what you're basically doing is taking value from your current shareholders and transferring that value to the shareholders of the target company, right? So the gain here, the increase from $15 per share to 17 is basically the value that is transferred, taken from the acquirer shareholders and given to the shareholders of Darboe, right? So usually in this kind of transactions, if you are the manager, you could eventually get fired for not doing a good job, because usually if the concept is all the shareholders should benefit from an M&A transaction. And that's why it's very important to pay the right price, sort of, not to overpay. Yes. So I'll pause a bit so that you can take notes on the third question before we move to the fourth one. Okay, So we move to the fourth one now. And, the fourth one is quite interesting because it asks for what is the premium. It asks for the premium that the Darboe shareholders are going to get from this transaction, right? And already, if you remember from the previous section, we were told that the premium of the transfer, the acquiring company is going to pay 20% premium, right? So in a kind of exam, when you have a very limited amount of time and there are many questions to solve, it's quite intuitive just to use that percentage and basically write that the premium from the transaction is 20%. But in this case, that would be wrong. And we will see why. But 20% will not be the actual premium that the Darboe shareholders would have from this transaction. So to find the actual premium, we need to, again, know the standalone value of Darboe, which is 60 million. That is the true value of Darboe, what it is worth. We also need to understand how much is paid by the acquiring company, which again is 68.82, as we found in the previous section. And it's literally the value of the combined company times the percentage that is held by the Darboe shareholders. And now we can calculate the actual premium, which is basically the value that the shareholders received divided by the actual value or the true value, if we would put it that way, and find the percentage, which is 14.71%, right? And obviously, like I said before, this is less than 20%. I'm not sure if there's anyone who can explain why this is the case. I'll give just a minute to see if someone can explain to us why this is the case. Okay, too bad, no volunteers this time. Okay, so the premium is less because for two reasons. One, this is not a cash transaction, so they are not paid with cash, and therefore the value of the actual value would depend on the share price of the acquiring company after the transaction, right? And this is not known in advance. So the premium, the 20% premium, was based on the share price of the acquiring company before the transaction, right? Which was 20, right? But the actual premium would depend on what is the price after the transaction. And then as we see before, we know that the price has gone down because they are overpaying and there is no synergy. And as a result of the decrease in price, this would have an impact on the value that Darboe shareholders would eventually receive, right? So usually this is also quite an important consideration in M&A transactions, especially if it's the stock that is going to, if the offer amount is going to be paid with the stock of the acquiring company, it's very, very important to understand how the price would be after the transaction, right? Because this would determine the actual value to the shareholders, right? So in this case, one way to see this is even though for each of the Darboe shareholders would definitely receive 0.9 shares of Acquiro, the value of this amount would depend on the price of Acquiro, right? So now they have something, it was worth 20 and now it's worth just 19. And because of this, the premium that they end up getting would be less. And in this case, it's almost, it's 5% less. It's 5% less than what was promised, right? So usually this would be something that would be quite important to the shareholders of Darboe, because at the end, what they care about is not the premium that was promise based on the pre-announcement price, but it's usually the premium that they would get after the transaction, which also depends on how the prices of the acquiring company moves after the transaction, right? So in this case, we know that it's not a good deal for the acquiring company because they are paying too much for a company that is worth less than what they are paying. At the same time, they are not getting any synergies. And as a result, the share price went down. And the drop in the share price also have an impact on the value that the Darboe shareholders are going to get from this transaction. Right. So this is basically why the effective premium is lower than the promised premium, or the premium that was considered at the announcement, right? So it's from a logical point of view, it's always important to make this kind of considerations because if you would know that they are overpaying one, so it would have a negative impact on their price, and you know that they are going to pay with stock and not with cash, you can definitely conclude that the value or the premium would be less than what is promised, right? So in this kind of question, if you would end up with an actual premium that is in fact higher than 20, it should tell you 100% that the answer is not right. Because from the facts, you know that the premium is going to be less. Even if you don't know exactly how much, you definitely know that it's going to be less. Right, and I think the note below here is just emphasizing that point why it's less after the announcement, right? I'll just pause for a moment so that you could take notes on this part. Or ask any questions that you would have regarding this. Good. So now we can move on to the last part of this question, which is more of a theoretical question. And the question was, what actions or takeover defenses can the Darboe shareholders do in order to avoid this transaction, right? So if to avoid a hostile merge, M&A sort of. So what could they do in order to stop the acquiring company from acquiring Darboe? And here there are quite a number of options available to companies, but I think the most common ones are these three here. So one is the staggered board, and how this works is this. So you structure your board in such a way that for every given year, there is just a small amount of the board that is up for the election. So let's say if the total number of people on your board of directors is 10. You structure it in such a way that every year only 2 of them are up for the election, right? And then the 8 would be there because they are not up for the election, so they would continue on the board, right? And why this would be bad for the takeover for the acquirer is that if the board do not want the transaction, even if acquirer has control over the shares because they bought, let's say, more than 50% of the company's shares, they cannot still change the board because only 2 people are up for the election. So they can change only 2 people out of 10, and the other 8 would be still in the board. And if they don't want the transaction, they would not approve or they would not recommend the shareholders to go with the transaction. So that's one way one strategy that companies use. Another strategy is the poison pill, which is basically that if the company suspect or expect that another company is going to try to acquire them against their intentions, what they could do is to issue shares to existing shareholders, so shareholders that are friendly to them, that they think are not interested in the deal as well, at a discount, right? And what this does is that it makes it even more expensive for the acquiring company to acquire the target, because now they need to buy so many shares, and they would have to buy these at these shares would obviously be valueless. Will be valued less. Yes. Then the third one is leverage recapitalization, which is basically the company that suspects that another company wants to take them, to buy them, could just go and borrow so much debt and use that amount to buy back its shares, right? And the reason that this would be bad for the acquiring company is that because also interest tax shield is an important consideration for mergers. And if you know that the company that you are buying is already highly indebted, it means that you cannot take more debt in the company, and because of this, you will not have any interest tax shield. And with the absence of interest tax shield, it means that there is no benefit of acquiring the company. There is no synergies, at least in this regard. So these are the three processes that companies can take in order to avoid takeovers, which is generally referred to as takeover defenses. This is all from me. If anyone has any extra questions with regards to these two questions that we've looked at, you can ask. Okay, it appears there are no questions. This is all from us, I guess, for this session. I think me and Fredrika would be here for the next 5 minutes. If anyone has questions that you would want to ask in private, you can feel free to do so.
Yes, and otherwise the slides will be posted in the Facebook group during the afternoon.
Cool.